Hello and welcome to another edition of Investing for Dummies Who Don't Know They're Dummies. Tonight we're diving into the wild world of ETFs or exchange-traded funds, which sound way more complicated than they actually are. Think of it like this. Remember how excited people got about those snack packs with all the different chips? ETFs are kinda like that, but instead of chips, it's stocks. And instead of satisfying your craving for salt, they could potentially help you retire someday, maybe. Now we know what you're thinking. John, I can barely understand how to use the self-checkout at the grocery store, let alone navigate the stock market, and to that we say, fair point. But the good news is, ETFs are designed to be relatively easy to understand, even for those of us who still consider a 401k some sort of bizarre typing test. So, buckle up, Buttercup, because we're about to break down the wonderful world of ETFs in a way that even your Uncle Gary, who still thinks Bitcoin is a type of vitamin, can understand. Alright, let's start with the basics. What the heck an ETF? In the simplest terms possible, an ETF is like a big basket of different investments. This basket can hold stocks, bonds, or even commodities like gold or oil. Instead of buying each stock or bond individually, you buy shares of the ETF, which gives you a tiny piece of everything inside the basket. It's like buying a variety pack of chips instead of just one bag of potato chips. Now you might be wondering, why would I want a little bit of everything? Well, the beauty of ETFs is that they offer instant diversification. That's a fancy way of saying you're not putting all your eggs in one basket. If one stock in the ETF doesn't do well, it might not affect your overall investment too much because the other stocks in the basket can pick up the slack. It's like having a team of superheroes fighting for your financial future. So, how do these magical ETFs actually work? Well, imagine you have a group of friends who all want to invest in the stock market, but they don't have a lot of money individually. They decide to pool their money together and buy a bunch of different stocks. They then divide the ownership of those stocks into shares, and each friend gets a certain number of shares based on how much they contributed. Congratulations, you've just created a rudimentary ETF. In the real world, ETFs are created and managed by big financial companies. These companies decide what goes into the ETF basket, whether it's stocks from a specific industry, bonds with different maturities, or even commodities like gold. They then list these ETFs on stock exchanges, just like regular stocks. This means you can buy and sell ETF shares throughout the trading day, just like you would with any other stock. Easy peasy, lemon squeezy. Section 4. The upsides, why everyone's talking about ETFs. Okay, so now you know what ETFs are and how they work, but why are they so popular? Well, buckle up because ETFs come with a whole host of benefits. First off, they're super convenient. You can get exposure to a diversified portfolio of assets with just one simple trade. It's like ordering a pizza with all the toppings instead of having to pick and choose. Second, ETFs are generally more cost-effective than traditional mutual funds. They have lower expense ratios, which are the fees charged by the fund managers. This means more of your money is actually invested in the market, working hard to grow your wealth. And who doesn't love keeping more of their hard-earned cash? Finally, ETFs offer a high degree of transparency. You know exactly what's in the ETF basket at any given time. No more blindly trusting a fund manager with your life savings. It's like having a window into the inner workings of your investment, which, let's be honest, is way more exciting than it sounds. Section 5. The downsides. Because nothing in life is perfect. Before investing your life savings in ETFs, consider the risks. ETFs are only as good as their assets. Poor asset performance means declining ETF value. Tracking error is another risk. ETFs may not perfectly track their index. Finally, ETFs are subject to market volatility. Prices can fluctuate throughout the day. Section 6. Conclusion. ETFs, a revolution in investing. So there you have it, folks. Everything you need to know about ETFs explained in a way that even your goldfish could understand. ETFs have revolutionized the investing world by offering a simple, cost-effective, and transparent way to access a diversified portfolio of assets. They're like the Swiss Army knives of the investment world. Versatile, efficient, and surprisingly affordable. While ETFs do come with some risks, as with any investment, the potential rewards can be significant, especially for long-term investors. So, if you're looking for a way to dip your toes into the stock market without drowning in fees or complexity, ETFs might just be the answer to your prayers. Just remember to do your research, choose your ETFs wisely, And most importantly, don't invest more than you can afford to lose. Happy investing.